In an equity swap, at least one of the two streams of cash flow is determined by the price of a stock, value of an equity portfolio, or the level of an equity index. The other stream of cash flows may be based on fixed or floating interest rate, or it may be determined by the price of another stock or the value of another equity portfolio or another equity index. Equity swaps are similar to interest rate and currency swaps. However, there are notable differences. For example, the swap payments are determined by the returns on a selected stock, portfolio of stock, or equity index. The return on equity can be negative also, so it means that the swap payment can be negative. For example, if party A is paying the equity return and party B is paying fixed rate, if on a given settlement date the return on the equity is negative, then party A will have to make no payment, but party B will not only pay the fixed rate but also pay the negative return on equity to party A. Another difference is that in an equity swap, the upcoming payments are never known. The upcoming payment, both fixed and floating on currency and interest rate swaps, are known in advance. The equity return is known only on the day of the settlement. Finally, the payment on equity swap for equity return are not adjusted for days divided by 360 as full return on equity is paid. The cash flows to a party paying equity return and receiving the fixed rate is given by this formula. We see that the equity return is not adjusted for days divided by 360. To understand the mechanics of equity swap, let's have a look at this example. IVM enters into a swap with counterparty FNS where it pays the total return on S&P 500, that is the equity index, and receives 3.45% fixed rate. Payments are made every 90 days for 1 year. At the start of the swap, the S&P 500 index is at 2710.55. This value and the value of the S&P 500 index at the day 90 will be used to calculate the return on S&P 500, that is the equity returns. The value of the S&P 500 index on day 90 will then become the initial value of the index for calculating the index returns for the second 90-day period. Using the information in the example, the payments on the swap for IVM are calculated as 25 million multiplied into the difference between 3.45% multiplied into 90 over 360 and the return on the stock index over the 90-day period, that is the 90-day return on S&P 500 index. The fixed side payment is known in advance, that is 25 million multiplied into 3.45% into 90 over 360, and that gives us $215,625. However, the equity side payment and the net payment on the swap will be only known at the settlement date. The payments on the equity swap in our example are shown in table 11.8 for assumed values of the index, that is the S&P 500, on each settlement date. Let's have a look at it. We know the fixed payments on the swap for the swap period, that is every 90 day 215,625,000. The equity payments on the swap are calculated as the S&P 500 index value at day 90 divided by the S&P 500 index value at the start of the period minus 1. This gives us the equity return in the swap. We multiply this by the notional principal of 25 million to get the respective equity payments in the swap. The first payment is 501,282 and it is obtained dividing 2764.9 by 2710.55 as the payment on equity side that IVM has to make is 501,282 and the fixed payment due from the counterparty in the swap is 215,625. So IVM has to make a net payment of this amount here minus this amount, that is equal to 285,657. In the second quarter, the equity return is negative. So IVM not only receives the fixed payment from FNS but also receives this negative return. So the total payment received from FNS by IVM is $1.221538 million. In the third quarter, the equity return is positive. So again, we see IVM has to make a net payment. In the fourth quarter, we see the equity return is negative. So it receives a net payment from FNS, which includes the fixed return as well as the negative return on equity. That is a total of 1.1 million. If the counterparty will pay a floating rate or the rate of return on another equity, the formula is adjusted to reflect this arrangement. So we see here the fixed rate is replaced with LIBOR, and if it is the return on another index, then we see that the formula does not have the days divided by 360, as both returns are equity return. To price an equity swap that pays fixed and receives equity return, we use the replicating portfolio approach in line with arbitrage-free pricing. In our replicating portfolio, we borrow or issue a bond at a face value of $1 at which interest is paid at the rate R at every settlement date. We invest the $1 borrowed here into a stock, so our net investment in the portfolio is zero because we have a stock worth $1, that is an asset, and we have borrowed, that is a liability, and it is also worth $1. So the net position in the portfolio is zero. Suppose the term of the loan or bond is 1 year. Interest is paid on day 180 and day 360. On the day 180, the stock will be worth the price at that day in the market, that is S180. Remember, when we purchased the stock, it was worth S0. So we sell the stock at the stock price on day 180 and receive the return on the stock. We can write this as the stock price on day 180 minus the stock price at which we purchased it at the start divided by the stock price at the time of purchase. This gives us the stock return for the first 180 days. We withdraw the stock returns from this investment here, and then we pay the interest we owe on the borrowed amount, that is $1. So that is equal to $1 that we have borrowed multiplied into the rate of interest that we need to pay on it, multiplied into 180 days divided by 360, which is represented here by Q. Though this is only R multiplied by Q here, it is understood that it is multiplied by the notional value of $1, that is this whole term here. The net return on the portfolio where we are long the stock and short the bond is given by the return we have from the stock minus the return we have to pay on the bond. This is represented here by this whole term. This is the return on the stock and this is the return on the loan or bond. The difference between these two is the net cash flow or the net payment on the portfolio. Equating this to a swap, it will give us the first swap payment on day 180. Note that we still owe the $1 on the bond or the loan, and we already have $1 left from the sale of the stock on day 180. So this $1 needs to be invested, which we are reinvesting on the same day. The same steps are followed on day 360 to get the net payment on day 360. As this is the end of the swap, so the stock is liquidated and the amount realized from selling the stock on day 360, that is $1, is used to pay the principal amount on the loan or the bond issued. For end payments, The value of the portfolio at the start will be given by the $1 invested in the stock plus the present value of the bond, which is equal to the present value of the par value and the present value of all the future interest payments. The negative sign here indicates that these are future cash payments in the portfolio. As we know that at the start no cash changes hands, so the value of this portfolio should be equal to 0. So we set this equal to 0 and then solve for R, which effectively gives us the fixed rate formula in a plain vanilla interest rate swap that we have on the next slide. For the mathematical derivation of this formula, see the video on interest rate swaps. The pricing of the IVM equity swap in our example is illustrated in table 11.9 with assumed LIBOR rates in the spot market for 90, 180, 270 and 360 days maturities. The term structure of the LIBOR rates is then used to calculate the values of zero coupon bonds, that is the discount factors for the respective maturities. These values of zero coupon bonds or discount factors are then used in the fixed rate formula to get the fixed rate equal to 3.45% for our IVM example. The value of the equity swap anytime after it is initiated is the difference between the value of the equity position and the value of the loan or bond, which is given here by the present value of the par value at time t and the present value of all the interest payment at time t. We value the IVM equity swap to illustrate this in table 11.10. 60 days into the life of the IVM equity swap, the updated term structure of LIBOR rates for 30 days, 120 days, 210 days and 300 days is given. Using these rates, the zero coupon bond values or discount factors have been calculated. The value of the S&P 500 index at day 60 is given, which is equal to 2739.60 points. At the start, it was equal to 2710.55. So this will give us the value of the equity. The value of the fixed rate bond or loan is equal to the present value of the face value of $1, which in this case is equal to 0.9677. That is the zero coupon value for the bond maturing in 300 days. And then we have a fixed interest payment of 3.45% every 90 days, 30 days from now, 120 days from now, 210 days from now, and 300 days from now. So the present value discount factors for these maturities have been added up and multiplied into the fixed payment of interest to be made on the loan. This whole will give us the present value of all the future interest payments today, that is on day 60, and this is the present value of the par value on day 60. So if we deduct the value of the loan side or the bond from the value of the equity, it will give us the value of the swap in which the party is receiving equity return and paying the fixed return. However, IVM in this example is receiving fixed and paying floating. So as a counterparty, it will have a negative sign here with this value. Now remember, this is the value of the swap assuming a notional value of $1. To get the value of the swap for IVM over the 25 million notional value, we simply have to multiply the value of the swap per $1 notional value into $25 million, and that gives us a negative value of the swap for IVM of $227,964. So IVM has a derivative swap liability and has no credit risk. However, the counterparty, that is FNS, will have a derivative asset and will bear the credit risk in this transaction. An equity swap to receive floating rate and pay the equity return is equal to two swaps, in which the first one involves paying equity return and receiving the fixed rate, while the second one involves paying fixed return and receiving floating return. The pay fixed and receive fixed crosses, so the two swaps are equal to receive floating return and pay equity return. Given this equivalence, we can value an equity swap to receive floating and pay equity as a combination of an equity swap to pay equity and receive fixed plus an interest rate swap to pay fixed and receive floating. Suppose we want to value the equity swap to receive floating and pay equity 60 days from the start, that is the initiation of the swap. So we first value the plain vanilla swap, in which we have to value the fixed rate bond and the floating rate bond. The value of the fixed rate bond 60 days into the life of the swap will be equal to the present value of all the interest payment plus the present value of the par value. We did this in table 11.10, so it is equal to $1.001598884. The value of the floating rate bond will be equal to the present value of its future cash flows in 30 days time. This 3% is from table 11.9, where we valued the IVM equity swap and calculated the fixed rate to be 3.45%. The first rate there for 90 days was 3% in the term structure of LIBOR rates. So the present value of this interest plus the par value of the floating rate bond on the next reset date, that is $1, is equal to the floating rate bond value on day 60, and we have used the 30-day discount factor on day 60. Now to calculate the value of the plain vanilla swap, we simply have to deduct the value of the liability here, that is the fixed rate bond, from the value of the asset, that is the floating rate bond. Remember, we are receiving floating rate and we are paying fixed rate. So the value of plain vanilla swap with a notional value of $1 is equal to $0.00297941. For the actual 25 million notional value in the swap in IVM example, the value of the swap will be equal to 74,485. That is 25 million multiplied by the swap value per $1. The value of the equity swap to pay equity return and receive fixed return is 227,964 negative. We calculated this value for the IVM example in table 11.10. We now also have the value of the plain vanilla swap to pay fixed and receive floating. Adding these two values here will now give us the value of the equity swap to pay equity return and receive floating return, that is equal to $153,479 negative. So we have numerically demonstrated now that an equity swap to pay equity return and receive floating return is equal to a plain vanilla swap to pay fixed and receive floating plus another equity swap to pay equity and receive fixed. The pricing of an equity swap paying one equity return and receiving another equity return can be illustrated using replicating portfolio concept. Short one stock and go long the other. Each period, withdraw your cash return by selling the stock and then reinvesting the $1 back. On the short side, cover your short position by buying it back every time and then selling it short again for $1 at the start of the period. At the start of each period, you will have a $1 long position in one stock and a $1 short position in the other stock, so the value will be 0. Modifying the IVM example, we assume that IVM pays the return on S&P and receives the return on NASDAQ. The S&P index at the start has a value of 2,710.55 and goes to 2,739.60 in 60 days, while NASDAQ has a start value of 1,835.24 and goes to 1,915.71 in 60 days. The value of the swap for IVM 60 days into its life is equal to the value of the Nasdaq position minus the value of the S&P position. It is just equivalent to having a long position in the Nasdaq index and having a short position in the S&P index. The resulting value is $0.0331297.4, and for a notional value of $25 million, it will give us the value of that swap equal to $828,244. Equity swaps are quite useful for equity investors. These are like leverage equity investments where the equity investor receives the equity return and pays a fixed or floating rate or even the return on another equity. An equity swap paying fixed and receiving equity is equal to issuing a fixed rate bond and then investing the proceeds in equity. An equity swap paying floating return and receiving equity return is equivalent to issuing a floating rate bond and investing the proceeds in equity. An equity swap paying one equity return and receiving another equity return is equivalent to short selling one equity and investing in another equity. Equity swaps can be used to synthetically alter the exposure on an investment. For example, an investor with fixed rate bonds portfolio can use a pay fixed and receive equity to synthetically change his bond portfolio into equity. Similarly, an investor with an equity portfolio can use a pay equity and receive floating swap to change his equity portfolio to a floating rate bond portfolio. Figure 11.8 illustrates how IVM uses the equity swap in the example to change its equity exposure to a fixed bond portfolio synthetically. It agrees to pay equity return on S&P 500 index to FNS and receive fixed 3.45%. This helps it to change the exposure of its portfolio of domestic large cap stocks from equity to fixed. It must be noted that there is default risk in equity swaps like any other over-the-counter contract. Also, tracking error may cause imperfection as the equity in the swap and the actual portfolio may differ. Also, there is a risk of cash flow shortages as the return on the swap are actually paid in cash. However, the underlying portfolio or stock may have significant unrealized capital gain. This creates risk of cash flow shortages for payments on the equity swap. Generally, it is believed that the US Treasury's rate is the correct discount rate to use in swaps valuation. However, it has been considered as a biased low estimate of the risk-free rate for a variety of reasons and is also subject to influence from the Fed and the government for fiscal and political objectives. Alternatively, LIBOR was considered and used as a discount rate by derivative dealers that was considered to be more appropriate and market-based. However, the LIBOR scandal that came out during the financial crisis led market participants to lose their confidence in LIBOR as the discount rate in swaps. Derivative dealers started to use the overnight index swap rate after the LIBOR scandal. The OIS rate, that is the overnight index swap rate, is the geometric average of the effective federal funds rate. The overnight rate, that is the federal funds rate, is the rate at which banks borrow from the central bank. Derivative dealers now use the overnight index swap rates to value swap contracts. It is considered as the proxy for the risk-free rate by derivative dealers in the market. The value of a swap is subject to different adjustments. In the equation here, we see that the value of the swap is equal to the non-default value minus the credit value adjustment plus the debit value adjustment minus the collateral rate adjustments minus the funding value adjustment. NDV of a swap is the non-default value of the swap calculated by discounting the payoffs from the swap at the risk-free rate. Remember, the risk-free rate here is OIS rate, that is overnight index swap rate, and not the LIBOR or the treasury rate anymore. CVA is the credit value adjustment, which is the present value estimate reflecting the risk of default by the counterparty on the swap. If the counterparty has deposited adequate collateral, then CVA will be equal to 0. Debit value adjustment, that is DVA, is a mirror image of CVA and it reflects the firm's risk of default to the counterparty on the swap. In our example of IVM, the two parties are IVM and FNS. So when the swap has a negative value for IVM, it has a positive value for FNS. Now FNS here is bearing credit risk, so it will require IVM to deposit collateral, and in that case there will be a credit value adjustment by FNS and a debit value adjustment by IVM when they value the swap. If IVM deposits sufficient collateral, DVA and CVA will be equal to 0. We know that CVA and DVA are mirror images, so when there is sufficient collateral deposited by IVM, they both will be 0. Collateral rate adjustment, or CRA, is the present value of the rate difference, that is the rate on collateral less the risk-free rate. And remember, the risk-free rate is not the LIBOR or the US Treasury rate, but it is the OIS rate. If the rate on the collateral is less than the risk-free rate, then the CRA is positive. Otherwise, it is negative. If the position is perfectly collateralized with 100% cash collateral earning the same rate as the risk-free rate, that is the economic return, then CVA, DVA and CRA are all equal to 0. Funding value adjustment is the most controversial adjustment in valuation of swaps. It reflects the funding cost above the risk-free rate, that is the economic cost of an uncollateralized swap to a dealer with a client. The dealer hedges this uncollateralized swap with an offsetting collateralized swap with a central clearing party CCP or in the interbank market. The dealer has to effectively pay the funding cost on the collateral for the offsetting swap. The criticism of FVA is that the discount rate should reflect the risk of an investment and not the funding cost in the market valuation. Though we know the similarities between swaps and forwards, remember it is only for fixed rate swaps but not floating rate swaps. Even for fixed rate swaps, the analogy is partial as a series of forward currency contracts will have different prices. A currency swap will involve only fixed payments and hence cannot be strictly equated to forward contracts. To offset a swap early, that is to terminate it before expiration, you can go to the same counterparty, which is highly unlikely. To offset a swap or terminate it before expiration, you can go to the same dealer and request for termination or enter into an offsetting swap with the same dealer. This is highly unlikely. Alternatively, you can enter into an offsetting swap with a counterparty other than the original dealer. In this case, there will be now two contracts outstanding with two different counterparties and hence the credit risk will increase. You can also terminate a swap using forward contract known as forward swaps or using options on the swap known as swaptions.